Just like with your community, Dave, we believe the people in the room matter, the investors matter, and that they can really add value to each other's lives.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? And welcome to today's show on Wealth Strategy Secrets. Today's guest is Josh McCallen. Josh is the president of Viva May Hospitality and distinguished leader in the resort and real estate sector that serves over 325,000 guests per year and has acquired over 1,000 acres of prime real estate. You may have also heard Josh on the popular Capital Hacking podcast, which I was a guest on as well. And also, Josh is a repeat guest on the show, and today he shares with us how he balances family and business growth, tax strategies, and also investing in the hospitality sector. Josh, my friend, welcome to the show.
Dave, every time I get to be with you, it's once in a while at events. You're just warm. You always welcome me into your circle, and it's a big opportunity to be with you on a podcast and get to talk to you and your community. Thank you.
100%, Josh. It's always such a pleasure connecting, and I think it's like, you know, when you have these like minds that connect, right? There's kind of this instant bond, which is actually a really special thing where you can kind of go deep with people, you can connect, you can open up, right? Yep. There's no egos, and you can just kind of get into the conversation. So, really appreciate that about you, and not to mention the fact that you killed me. I thought, with having triplets, right, and 4 kids, that, I trumped everyone, but tell the audience about your family.
Yes. So my lovely wife of 27 years has been so kind and so generous to offer us the suffering of birth 10 times. She's had 10 of our beautiful children, and we're so happy together. I grew up with just one brother, so I didn't know the other side of the coin here, but I'm so happy. I'm sure with the triplets, that's even more challenging, brother. So I'm going to give you more credit than what we have, because, our theory, when you have a multiple like a long-term family where we've been having children for 20 years, you have the bigs, the middles, and the littles, and you kind of design an ecosystem of collaboration with the bigs. And then the bigs get too big, something comes over them, and they're not as helpful anymore. But the middles, they start to like come into their own, and then it becomes a little even easier because you get the bigs with the driver's license, the middles that are responsible, and the littles are just like a little team of hooligans. They're just having a good time. It's actually fun to watch.
That's really cool orchestration that you have going on. I was just in the zone defense world.
Yes.
Right? Trying to manage as much as we could, the best.
How old are they now, Dave?
So, this is pretty interesting. So I'll share something with the audience here. I am actually about to be a grandfather. My oldest is 25 and she's expecting in October. So it's going to be super exciting to have a G2 showing up soon. So we'll be doing some estate planning and things like that. That'll be, it's going to be really exciting. We're excited for that. And then the triplets are 23 now. And, I wanted to ask you this, as we're, kind of talking about family, because our audience is really connected to family, as is yours. I know, right? This is why we work really hard. And we want to pass on these concepts, this learning that took us, frankly, too long to learn, right? So I think there's a big, responsibility. And I've been finding that, it's more and more challenging as your bigs, the older guys, once they get past college, they move out of the house, they're building careers, they're building lives, they're getting married, they're doing all those kind of things. So it's actually really challenging to bring everyone together, talking about things like, values, right? Next gen philosophy, concepts, having a family constitution, right? all of these types of things. So I'd be curious if, you guys have anything in your household or practices or things that you could share with the audience on that.
I do. And it's one of our virtues in our business. We say we're seeking 3 virtues: joy of service, humility, and ministry in all the work we do. Guess what? Humility. Okay. In all humility, we have clarity of thought around this. We have some execution, but I can't say the results are there. So what's going right? One, I joined full-time this Halftime Institute, year-long. They call it 100X, where you need to be thinking about the second major contribution you're going to be doing with your life, through your family, and through your work as a ministry. And that's with Lloyd Reeb, and it's a really awesome organization. I think you would enjoy meeting them anytime. So Lloyd Reeb helps us think through these things. So if I could show you hilarious quantities of binders of all our thoughts and visions and meeting agendas for families. And then you probably know Jim Shields, the guy who wrote 18 Summers. He's also a good friend of ours, and he's always kind of encouraging that. So we have a lot of mental momentum created. We have some execution. So the execution, what did it look like? We, for the last 2 years, have had intermittent family meetings where we drew out what Melanie and I are trying to do as parents and what we want to hear what they want to do. So it's been much more of a curiosity open forum, and we documented, we had everybody write their goals. This nuance of trying to motivate adults, middles, and littles, the littles actually got pretty on board with it. They thought it was really cool. The ones that can write well were really writing out pages and pages of goals and ideas and what they want the mission of a family to be. The middles also. The bigs, you know what? They sometimes weren't there, and we never quite got them into the fold. But we are living much more intentional because of at least taking a few steps. So that's my message to our audience. Did we really get it done? No. Do we have the start? And is the vernacular there? The family understands. For right now, we're in that grind, Dave, where business is growing. The capital demands of turning businesses around keep all of our money in the businesses. And so at home, we look like a middle class to low middle class family for the amount of amenities we have. It's modest, right? And there's not lavish things for children. There's not the big lavish thing we do is a vacation. And so the vacations, there's 2 big ones a year. We try to make those part of these family plans. So we'll be in the only big luxury I can tell you we bought, Dave, and I think I'd advise this to anybody with children at different ages and you want to keep them together, is I guess we have 2 luxuries we bought over the last 5 years. A pontoon boat, which doesn't sound that big of a deal, but it traps you as a whole clan at one time to putz around and maybe water ski, what do you call a tube? So that's been a good investment of bonding. And then a couple of years ago with 10 children, we were trying to get everybody to Florida for a vacation. And all of a sudden we're like, wait a second. The price of these tickets are the price of a year's worth of payments on a RV, kind of an RV. Yeah. It's basically a van with a bathroom. Okay. It doesn't actually have full bed components. And that has changed our life too, because we can trap them all into a nice, comfortable experience and go on trips. So the Florida trip once a year is in one big van. And of course, one adult or 2 might not get in it, but the rest of us are in it. And then pontoon boats. So I hope I've, opened the kimono. Some things are going in the right direction. Some things haven't. But we've helped the kids see that Melanie and I feel that just like that Halftime Institute says, it says, good, you're talented at certain things in your first half of your life, but why? Why are you here? That's the question of halftime. And how can you add significance to those around you? And the talents that you developed over 49 years old now, where are they best deployed for your next 50 years? And we feel, definitely a grace from God, we feel we landed right where we're supposed to be. We love the family. It's number one priority in life. We're all very well connected. That's good. But our business, which we haven't talked about much, it's almost as if it was a gift from God. The way it comes together and combines and challenges us. I mean, it challenges us, Dave. And I think that's a good thing. Like the Stoic philosophers from 2,000 years ago, Marcus Aurelius, that the struggle is the way. So our challenge of the struggle is very real, and it bonds Melanie and I to keep the first things first. In our family, some of my adult children say, why does it have to be so hard? Why do you guys have to be so hardworking? I don't know. I feel like that's actually a good for them to see, since so few people work hard anymore. There's my life story, buddy, as far as the family integration with work and mission. And I would say in the last 2 years, we've moved really close to where I'd like to see us getting to annual family meetings and quarterly updates. And I think that'll probably be in place by this fall.
Yeah. I really love that, Josh. I mean, really great insights. And I love how you framed it by, talking about the progress, versus the perfection, right? What is going well, versus kind of getting caught in the gap right there. But I think it tells a lot about, who you are. And it's interesting, in our mastermind community, this topic comes up very often. And people, it's very dynamic as well, right? Because not only you're raising kids, a lot of us have, elderly parents now we're trying to care for, and you've
That's
got,
right.
Different issues there. So it's a very dynamic thing. And so how are you managing it with all that we've learned, and as a like-minded community, how can we learn from each other to really make that kind of impact? So appreciate those insights there. So why don't we jump into, a little bit more, about what you're doing with Renault. I know since the last time we had you on the show, I think 2 years ago, you've added some additional properties, and business has been going well for you. And I was always amazed at really, the resilience of your business as well, Josh, because if you talk about, hospitality as an industry on the whole. And we met before the pandemic. And I always thought, wow, that's going to be interesting, right? But then when you start unpacking how you run your business and the different types of ways you're servicing your clients and things like that, I think is a lot of ingenuity to that. So tell us about what's going on. What's the latest?
Yeah, so you're right. I mean, we feel the ingenuity is the key to our growing and our successes as a team. We have almost 450 people on payroll this month, over 4 properties, soon to be 5 by the time you probably release this. And what is our business? Let me just back up. We had built an expertise working for a big family office from 2008 till off and on because of the recession. But back in full swing, we went from building them luxury flip houses, which were $5 to $10 million flip houses on the beach. I was the project lead for that family office in the late 2000s, before the crash. And then after the crash, we pivoted into salvaging a bunch of a hotel that he had bought to flip, that he never flipped. And so that's how we got into the deep repositioning strategies of hospitality. And so then that became my core expertise for the next X number of years with that partnership. And from that partnership, had the privilege of being able to launch what we do today, which is we let accredited investors join us. And now we do it through private placement. We don't just have one family office. We have 425 families. And then we have about a 4,000 person community of people that want to understand how to invest alternatively for tax strategy and for legacy, and to really hedge inflation. So that's kind of why our investors invest. But the day-to-day business, Dave, you're absolutely right. The day-to-day business is we take that capital that we're stewarding and we purchase very low basis, in need of turnaround, hospitality assets. And for now, in our first portfolio build, our core specialty is unrepeatable drive-to leisure properties from major wealth centers. What do they look like? They range from, we own 3 resort wineries now, or we will in a few weeks. We'll have our 3rd. 2 championship golf course resorts. Some of this overlaps. We have currently 3 properties have mega access to the Chesapeake Bay. So we have a lot of waterfront, and we have boat clubs going in all those. So you're hearing that we have hospitality as like the core operational language, but really what we are is a multi-revenue stream model on top of massive real estate. So the investors tend to like us because they love the hedge of owning, we'll own over 1,000 acres of prime real estate in the next few weeks. Right now it's in the 900s. Okay. And some of that is unrepeatable, right? We have one that we acquired this year ago was 440 acres on off of the side of the Chesapeake on one of the tributaries. And it was founded in 1660 as the home of one of the original influencers of the colonies. Okay. So then later it became a house, and then later it became a winery, and we bought it from the people that made it a winery. And we bought it for the basis of about the value of the house, right? So it came with a house, came with $7 million worth of production facilities and tasting rooms, multiple millions of dollars worth of the best vines on the eastern seaboard. They're terraced going down mountains or hills going in, off to the edge of the Chesapeake. So we got all that, I say, for free. Oh, and we got 400 acres, of which we lease out to commercial farmers. So when you drive up, Dave, if you can come over and visit, you'll see 300 acres of agriculture that we do not have to do. But boy, does it look pretty. And the drone flights for your wedding, you would feel like you're in the middle of 1800s. It's so pretty, right? So, and we get paid by that farmer. Oh, and thank God for that farmer, because with his agricultural exemption, we pay no tax on most of the property. So it's a killer, I say, free land bank, but it's actually a cash flow land bank with options for the future. So did I explain it in a complex way? Yes. The way we explain it to investors is we say, think of it this way. We're going to build a business model around first contractual wedding contracts and then other contractual revenue. And then from there, we'll have our cash flow amped up. And then on top of that, it becomes accretive. What else can we do? Can we add a beach bar? Yep. And that'll all be profitable. It'll accrete to the profit because we were not going to hire another general manager. Can we add fall festivals? Yep. That'll accrete to the profit. And we'll add corporate retreats, and we'll overlay some short-term rental strategies, and we'll explore glamping. So all these things are not even in the pro forma sometimes. They're just, right down the middle. Pro forma is pretty linear. We'll spend this much on marketing. We'll get this many wedding leads. We'll close this many weddings. And when you sell a wedding, you tend to sell two other contracts. They tend to book out all your rooms. So that's revenue a year in advance on your rooms. The spaces for catering are now rented. We charge a rent, plus we charge you for the food, and then we charge you for the staffing. And then on top of that, you're going to have all that new eyeballs. So, you and I go to weddings every once in a while with cousin Jenny invites us, and we get an invitation, and all of a sudden we're driving 2 hours and we get somewhere. You and I never heard of that place before. So what I love about the wedding business for the affluent contract is they're bringing all kinds of like-minded, high-spending leisure travelers to our property to go to Jenny's wedding. But thankfully, they're now part of our community. They've probably given us their email. They're probably going to come to a wine tasting event or a really cool chef's experience, or they're going to come back to the beach bar, or how about take a boat out? Because now we have jet skis and boats. And so it's this virtuous circle, but we're buying them below the cost of the buildings.
Yeah, that's really awesome, Josh. And the fact that you're able to book, those wedding contracts in advance. Aren't you even up to 2 years? Is it beyond 1 year now?
Yeah, regrettably, it's great. It's great, but 25 is mostly done. People tend to buy 25 already. So now we're into 26. And for those who've not had to go through this pain of paying for a wedding yet, we always say, great news. We're going to deliver on the value, but there is a significant financial investment. And the average wedding for us is about $50,000 in just the food and beverage. And then other things on top, right? Yeah. So we're going to ask you for 25% of that to 30%, depending on which state you're in. New Jersey, we get 25%. In Maryland, they give you 30%. It's part of the culture. So we're going to have that money for 2026 now, that was part of our secret for getting through COVID so well, is we were selling like crazy. Even when we couldn't feed you a cheeseburger or a glass of wine, we could sell you weddings. It was legal, and we did. And so that's how the crazy. COVID, and then we pivoted into other cool things at the COVID year. But really in a good way, it actually catapulted our business.
Yeah. Now, it's such a great business model. There's so much diversification in it and different add-ons and things like that. And also, I like that you're, creating those experiences for your guests, right? Which are, super memorable. And then also investors can actually experience that, right?
Dave,
Where else, can you go do that? You're not going to go stay in an apartment building, right? That's not going to be fun, or go look at a self-storage, right?
well, and you might say, I want to show you how cool that coin is. You and I love learning from people like Tom Wheelwright and Rich Dad Poor Dad's Robert Kiyosaki. And remember his lesson on whether the coin has two sides, flip the coin, or does it have three sides? The cool thing about the coin of investors being able to visit their properties and fall in love with them is awesome. But you know what happens on top of that is they become ambassadors. Or I always encourage them to feel like owners, because they own a piece of equity in the business. They're going to get all the tax strategy, all the yield, pro rata. So why not become an owner mindset? And so that has, it's happened many, many times. And so here's what I'm going to ask you. Who sells a property better than the owner? Nobody. What if we take the ownership, if there's 100% of mental ownership of a property, and I walk around with my iPhone and I talk about the beautiful things happening, 100% of my energy is focused on, I'm the owner. I love this. And when you show up and you're an investor, 100% of your mental ownership goes into saying how beautiful your property is. And so you take these 100%, not fractions of, we all feel compelled and excited to say how gorgeous this is, or how great the food is, or how, and it just compounds and compounds and compounds. And it's been really, to give you math, Renault was doing about $2 million a year in cash flow just a couple of years ago. This year it'll do $24 million in cash. And then it appraised when we bought it for pennies. We bought it, the whole thing, 226 acres, golf resort, a hotel, 150,000 square feet of meeting space and winery space for $5 million. And, recently it appraised for $48 million. And they say when we finish the spa we're building right now, it'll be $53 million. And I always say, great news. We turned away more revenue last year in rooms than we took. And that's not because we wanted to. It's because the capacity of the building has not yet expanded much. This year it will. It'll go up by 20%. But it could go up to 100% and still not capture. And we're not talking about small numbers. We were asked for $7 million worth of rooms last year for room blocks. This is just you and your family saying, I have my daughter's wedding. I want 20 rooms. I'm going to make sure my family all gets to stay together. Regrettably, with the amount of different events going on each day, I can't give you 20 rooms.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Because every bride deserves some rooms, doesn't she? You know what I mean? And that's the other thing I think people may not realize is we have multiple spaces and places and gardens. And so we'll be doing 2 to 4 weddings a time at the exact time. So that means that's how many people want to be on property that day. It'll be about 2,000 people want to be on property on a given weekend day.
Wow, that's huge. And that's just one property. That's just Renault. That's
just the big winery Renault. And so that Renault, what's also compounding, Dave, is people are thinking about us as not only turnaround, because most of our properties, we've been able to go from bankruptcy to success in a few years. So we're kind of getting a good reputation as a development group, a partnership group, an operating group that can really revive the value of properties. And so, municipalities tend to be very favorable to us when we go into them. They want what we bring to a town, and we want to be good citizens. So it's a virtuous circle happening there. Yeah, it's exciting times.
Yeah. So one of the other things, Josh, you and I really have in common as well is we love to talk about tax strategy. And it's something you've been able to execute on really well in your business for investors. So why don't you talk about a little bit of how does the investment model work,
Sure.
right? If somebody was to, come in as an investor in one of your properties.
Tax really caught my attention, and it all happened when I worked for that family office. I grew up humble, and then even when I worked, we made a good living wage, we got bonuses, but there was never a liquidity day until 2018 when we were able to exit one partnership and start this business. So Melanie and I were always more middle class than high net worth thinking. And where I started to understand tax and the power of tax was before I left the family office, was that magical moment of refinance, which is actually where I was able to earn my liquidity, was because we had built a business from just a few million to 100 million for that family office. And we were given equity at the beginning as speculation. And that generated an upside of millions of dollars. And that's how we got started. Okay. We moved from middle class to having to manage assets. So what was the most curious about that was the minimal to no tax liability that happened. And that blew my mind. And so then I started saying, oh, that's how this all works. And that's why real estate with operating business is the holy grail, right? Real estate with modest one line of business returns like multifamily is very, very good. But what if you took the value of a multifamily, which is great real estate, hedge against inflation and revenue, and you add 4 more revenue streams? Doesn't that produce more yield? And not only does it produce more yield, Dave, it produces more depreciation. Why? So in a multifamily, you get one really great bite at the apple of depreciation the first year when you cost seg. And then you get another one when you do a value add improvement plan and you fix it up, you get another good depreciation. Well, in the operating budget of hospitality, obviously we take the same piece of real estate at a multifamily might bring in $2 million in revenue in a year on a great year top line. We'll bring in $20 million. And so clearly there's a lot more cash flow. Doesn't mean that it's good or bad. It's just the way it is. Hospitality churns through a lot of money and a lot of people. But in that, there's layers and layers of tax strategy. If you follow where I'm going with this, when we have to buy tables and chairs, that can be bonus depreciated. Now, depending on where the IRS goes with that, that's been pretty lucrative lately, right? And we pass all that along to the investors every year. So it's not just one big bite at the apple in hospitality. It's far more than that. And so tax strategy has always been imbued in all of our private placements. It's designed to maximize it for investors. And I think people have really found that compelling. And I didn't realize how important that wasn't to investors until I watched it happen with my old partner. And then it changed me.
Yeah. So how does it actually work, right? If an investor wanted to kind of come into the property, is it really a cash flow play plus some of the depreciation benefits, or what is a typical model?
Thank you. Yeah. So over the years I've found, and I was surprised by this too. So I did not know that every investor is not like me until I took investors in. Some investors really want steady cash flow. Other investors want mega depreciation to offset their other businesses or whatever. And others want appreciation. So technically, when you buy equity with our projects, you get all three. Clearly, you get all three. There's going to be a cost segregation right away after the major project's done. You're going to get probably 20 to 30% back immediately as negative passive loss. And you're still going to make your preference payment. So you'll probably offset all your money we give you. But what about appreciation? So in our scenario, the typical investor, we don't ever promise more than 15% IRR, even though our targets are in the 20s. And the reason we say that is to always over deliver. And because there's so much more value add opportunity than maybe the normal multifamily, it almost seems surprising how much more IRR will be generated within 10 years. We do tend to think of it also in a different way. We're buying legacy assets. And so one of the other reasons investors like us is because there may never be that recapture day until the end. It's not a churn and burn. So we are not flippers. This is a portfolio strategy. And what do people think about that? They think, well, it's probably going to take them 3 years to get the stabilization. I'll probably get partial. I'll always get my preference payments, or I'll get compounded or delayed preference payments, but I'll get my preference payments. When do I get my money back? We always say, please realize we're here to turn a big business around. So 5 years is our goal for recapital through debt. And then we say, great news, there's multiple additional bites at the apple. You'll always keep your equity position, so you'll always have a check every year after you have your money back and your preference payments caught up and everything. There's probably a few exits of tangential assets. So, for example, we were on a call yesterday with a national builder, famous group that you would know, that once at Renault, this is semi-private information, but they want to support the expansion of neighborhoods around us. And so we will have some upside for our investors from that, even though it's not even in the pro forma. So that's a bite of the apple they're going to get just because they own the rights. Another bite at the apple we hope to get at Renault is we own the intellectual property at Renault, meaning Renault is 160 years old this year. It has never closed. It didn't close during the prohibitions. It didn't close during the Great Depression. It didn't close during the COVID. It never closed. So because of that, we have some 1800s intellectual property that very few people in the world have, including high-end brands of wine. So types of wine that are not allowed to be made in America. Champagne, we're allowed to make and call it champagne. We're allowed to call 5 other intellectual properties by their name. So one of the bites at the apple is we will eventually have partnership rights to license those unique assets to Gallo Wine or whoever, and they will be another bite at the apple because our investors own all that. So we love that. We call it off-balance sheet opportunities that are coming. And why do I say they're coming? This year begins our major capital raise for Renault, the next generation. So Renault is now a thriving business, and it has the potential to be an international name again. Remember, this is the place that Johnny Carson was a spokesperson for in the 1960s. It was the largest distributor of champagne in America in the 40s. Al Capone used to drink here. Nucky Thompson from Boardwalk Empire used to own it. It's got the craziest stories. Crazy. And they've been, the person who wrote that HBO show, Boardwalk Empire, if you've ever heard of that one, was the lawyer of Renault for 50 years. So he wrote it based on the stories that happened with Nucky, who was part owner here and everything. So we're like the most historic American winery, and we want the world to know it. Now we're a thriving business. I think we're going to become iconic over the next 10 years. And in that, there'll be many bites at the apple for partners.
Awesome. So people have an opportunity to still invest in Renault for that.
That's right. Starting soon. By the time you release it, it'll probably be open, and it will be calling it the America's Most Historic Winery fundraising program or capital program.
Wow. Very cool. That's awesome, Josh. You guys have really keep expanding and multiple properties in Maryland now.
Yep.
You'll have 3 in Maryland?
Yeah, we like this. This is, again, back to the buying right? We think our specialty is leisure experiential travel anchored by contracts of weddings. The best drivable portions of America are in a couple-hour drive of Manhattan. And so we got that locked down in New Jersey. Most of our brides come from the suburbs of New York City. And most of our clients do, our guests. We think DC has tremendous resilience. So the DC metropolitan circle of 2 hours, of which some of our properties are 45 minutes from the Capitol building. And when you get there, you feel like you left civilization. We have 200 acres of farm, and then we have a mile of waterfront at that one, 1.25 miles at that one. So when you get there, you might as well be by yourself. But it was 45 minutes from the Capitol building of DC. So that's why we have a whole boat club there and even fun jet skis so that you can come all the time. So our concept is, if we're in very easy drive shots of the wealthiest people in America, we'll always have perpetual revenue. And so that's our core business philosophy now. And we continue to expand those spheres of influence. We're looking at things in the Shenandoah Mountains west of DC, and wineries there and other amenities there. We have really great opportunities coming. Stay tuned for the future. And then we'll continue down the seaboards, eastern seaboard.
Yeah. Yeah, really impressive what you've done, Josh. So, and I know a lot of investors who've had great success. So, good for you guys. That's really great. When we started the intro, we were talking about investor mindset, and I find it to be such a fascinating topic, especially the times we live in right now with so many things happening in the world, right? How do you keep a steady compass, right? Geopolitical things happening, economic things coming, and you've had the opportunity to work inside of a family office. You're running a very large business, right? And so how have you been able to make stable decisions? What are you seeing in the future in terms of the economy? What are your thoughts there?
Well, I lean on a couple fundamental principles. One is, even though some of these properties we bought that were failing, they had such tremendous legacy that means in different economic cycles over the last 160 years, these places had a natural draw. And I look for what was that? What primordial reason did people need these places? Because I think as long as we stick close to human nature, which are things like beauty, experiences, agriculture, views, water, fires, I even throw in there because a lot of our properties have awesome fire areas. So these things attract and kind of soothe the human heart. And you're willing to drive. So we've taken out the risk of flying to Bermuda or flying to an island. You're driving. They're attainable. Our whole model is built on 4-star luxury, not 5-star luxury. So that means it's attainable by anybody with an income. You don't have to have high net worth to consume our properties. We host about 325,000 people a year. I think strength is in volume, personally. Attainable volume with aspirational experiences, I think, is a very important sweet spot. Now, how do we make other decisions? You were talking about investor mindset. I think one big thing that I gave a talk about in our last Learn and Grow event, where we have all these keynotes come in, we did one in the spring, and we're about to do one in August. Someone really challenged me. They're like, look, I'm in a bunch of syndications, and these multifamily deals are failing on different levels, usually related to debt. And why is it that the resorts are resilient to that problem? And I said, oh, you know what? That's fun that you asked me. I never talk about this, but it's probably a real strategic advantage for us, is that in hospitality, we've always had very high yield interest payments. We never got the privilege of the 2 to 5% interest rate. So our entire model, from the day I got here when the recession was not in place, has been expensive debt. So we knew that if we were going to produce investor returns, pay our bills, and pay our debt, we had to be a high yield business. So one, I guess our muscles are stronger than theirs. One, we just always had higher debt. And, theirs went up by what? 3 times, sometimes 4 to 8, I guess. It's double, right? Their interest rates might have doubled in the typical multifamily. Ours have only gone up by 25%. Why? Because they were already high. So we were already paying a premium for money. Interesting, right? So the inflation of interest rate it's not as revolutionary to us as it is to the multifamily. 2, our revenue streams are very resilient and we can change them. I predicted 4 years ago during the COVID that there's a day when they're going to start talking about governments. It'll become common language that they'll talk about not letting people increase rents by 10% a year. They call that rent control. And everybody's like, Josh, you're not talking about New York City, are you? I'm like, no, I think the government's going to get involved and talk about it. And now they do, don't they, Dave? They talk about how you can't raise rent so much. So anyway, we've always been able to flex rates, right? Our rates are up about 25%. And we learned during the COVID, we put in inflation adjustments to all our future contracts. So those are some things we've done. We've continued to use technology to get more efficient, and we've streamlined our business plan. But one thing investors say to me is, I came up with this one thing in that talk. I said, I'm not an economist, but there's something to the fact that if institutions during the heyday 2 years ago were willing to pay a 5 cap or less for multifamily, but the cost of base debt is higher than the cap rate, this makes it very disincentivized. Whereas our cap rates never got that compressed. Now you might say, well, I wish they got more compressed because that would make our buildings worth even more. Our Renault would be worth $100 million if we were doing this type of cash flow as a different business, because they would compress our cap rate. But our cap rates hover between 10 and 11% when appraised. So when you find out our properties are worth almost $50 million, that's at a very high cap rate. That means we're throwing off a lot of profit, which is good because, these partners that own it own all that profit. So I say to people, maybe we're doing well and going to be more resilient because we never had the artificially low cap rate and never had the artificially low interest. We've always had stable cap rates, actually penalizing cap rates, right? When I got into this for the family office, a cap rate on what we build would probably have been 7% or 7.5%. Well, now they're closer to 10. So our valuations, even though they're growing, could be expanding bigger if we come back down on cap rates. You get it? So those kind of factors make us look probably even better now in an inflationary market where we can hedge our own inflation, change our rates. No government's going to stop me. And low basis, we have tons of assets that have been purchased pre-inflation. So even just to buy our physical assets right now would probably be, if you were to try to build what we've built over time, and part of our strategy is to buy restorative properties because some people say that's more expensive. But I say, well, at least we own all the commodities that we bought and the stories. So those are some of the thoughts we talk about with investors.
Yeah. No, really excellent model, Josh, and appreciate you sharing, what it looks like now for investors. And I know it's been quite successful since you took it over and you just keep expanding. And I know that's a massive amount of, commitment and courage, on your standpoint, right? Trying to run a business like that and serving your investors, your employees, and all those that you serve. So great job with that. And it's also quite an interesting asset class for people to think about, especially while, we talked about, multifamily and other real estate assets, being really challenged right now, given the current interest rate environment. So could be a great asset to add to your portfolio. We like to talk a lot about portfolio allocation strategy and really kind of diversifying within a focused asset class. So I think this fits the bill quite well. Any final thoughts that you'd like to share with the community?
Well, Wealth Strategy Secrets is a great title. I hope people pick up on the fact that Dave did a great job with the tax strategies. The one thing I never really shared, though, was the legacy. That we're not typically going to flip out of these. So there should be perpetual infinite returns as well. And the last thing I'll say is, just like with your community, Dave, we believe the people in the room matter, the investors matter, and that they can really add value to each other's lives. So that's why we create those experiences almost quarterly called Learn and Grow. And your group would be a VIP group. If any of you guys want to come, we'll roll out the red carpet in August. We have keynote speakers coming in. The famous guy, Matt Sorensen, one of the biggest podcasters on alternative investing. He'll be our keynote. And we'll have our chief tax strategist there. So free tax advice for you guys, who designs all our funds and does some amazing work. So that's Learn and Grow. It's open to anybody. There's a small fee. It's at one of the properties. So you actually get to test and feel everything we've been talking about, Dave.
Awesome. Love it. Any other places that, if people want to learn more information, what is the best place?
Yep. We wrote a book, my wife and I. It's a downloadable thing right on accountableequity.com. Accountableequity.com. It shows you how we envision the cash flow patterns for these resorts and why they make money. And by the way, why they're one of the most preferred family office assets. Why are 4-star drive-to leisure resorts such a major part of mega family offices portfolios, all the way up to Bill Gates, who owns a major portion of Four Seasons? Why? And then why is the lady who created BET a billionaire lady expanding her portfolio of these drive-to leisure resorts called Salamanders. It's curious, and I think we've uncovered that code in that book.
Awesome. We'll make sure to link everything into the show notes. Josh, always such a pleasure to connect with you and learn so much from you. You guys have been doing an amazing job there, and really appreciate the opportunity to connect and really share your wisdom with everyone.
We appreciate you, brother. Can't wait to have you come on up, man. Or anywhere. Get on one of the boats.
Yeah, definitely. All right. Thanks again, Josh. Appreciate it.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.